What are you exactly positioning for?
Good to be here, Sarah and Carl. So first of all, you said short and shallow. I think Mike was talking about this. I think the Fed needs to turn off the air conditioning now. They have been really helping the economy because it was overheated coming out of COVID. And I think we all expect them to stop this pace. And I think what's been tricky in this economy has been sort of mixed signals. When you look at the labor data, it continues to be extremely strong. But when you look at the macro indicators, the inverted yield curve, and the other statistics you see, they kind of conflict with each other. Our view remains that it's a much more tricky economy to manage, and you need to be a little bit more innovative in managing the risk going into latter half of this year, and particularly next year, where we do see a lot more opportunity.
Because areas of the economy are less susceptible to rates, but others are historically the same?
Yeah, I'll give you a statistic. So we at Principal, we are one of the largest partners for small, medium businesses in America, but also not just in America, all over the world. And one of the things you see is we have this well-being index. And compared to last year, where half of small businesses were growing, 2/3 of the small businesses are growing right now. So you see this enormous momentum on the small and medium business size. But on the large side, you see a lot more headwinds. So what it is it's a lot more tricky. Our view is the small businesses will continue to do well. There is more growth happening there. I think another area we would talk about is this traditional debate between growth and value. We see international and EM becoming the value play for investors. What's really happening is valuations in emerging markets have stayed low and continue to be low. And as we come out of this short and shallow recession, there is opportunities there. I think in the U.S. you need to be a lot more discerning, but there is momentum going into quality growth in the U.S.
So you think the Fed is done?
Well, the Fed is going to pause, and we do think in somewhere around Q1 or Q2, you could technically see what is called a soft recession. But this traditional view that recessions mean a collapse in economy, a collapse in stock prices, is not going to happen.
Is it going to be enough to get them to cut or no?
I think they're going to stay for a pause, and then going into the beginning of the year, they will start looking at cutting. So my analogy would be they turn off the air conditioning. As we enter winter, they'll start to raise the heat, which is effectively saying they have to cut to stimulate the economy.
Early next year?
Early next year, Q2, Q3.
Because they're not expecting to go that soon.
They're not.
You just think the data is going to be worse, and it's going to make them.
Well, our view is I think the Fed looks at a lot of things. They look at the employment numbers, but they also have to look at other factors that are driving the growth. The cost of debt has gone up substantially, and that is going to, as you were just discussing, the industrials are going to be heavily affected. That's a large part of the economy. The manufacturing sector is going to get affected. So they do think they're going to look at all those data points to make this decision.
So does that mean you're Russell over the S&P or value over growth?
That would be, well, we are definitely Russell over the S&P, international over U.S. in certain growth areas. However, in U.S., we would choose more quality growth over momentum because that's where we see the most value.
And when you say international, you pointed to emerging markets before because we're starting to see some real weakness out of Europe, and China's been very disappointing.
Yeah. That's a fair point. I think when we talk international, we kind of take a global view. I would say India is a very fast emerging story. I think if you look at parts of Asia, particularly places like Vietnam and Thailand, they continue to do well. And I think there's parts of Latin America, particularly Brazil, we are extremely bullish on. So I think there are parts of emerging markets that will continue to do well here.
I wonder if you think, I mean, is it obvious that geopolitics are the biggest deterrent to going into Latin America?
Well, look, I think valuations create an opportunity. So I think geopolitics is priced into a lot of these stocks. Having said that, I think the rate environment in these markets is a lot more stable than we've had in the U.S.
Brazil's a good example.
Brazil's a good example. I think that stability of rate environment, sort of growth that is steady, creates opportunities for investors. And I think the key thing is, I would argue, just going back to this value discussion, I think there may be value in international and EM, but you don't want to get trapped in the index. What you want to do is find the right opportunities in the right sectors.
If you are expecting this recession early next year, which I'm not sure is consensus at this point, then are you a buyer of treasuries, fixed income? Because that's not really priced in.
I think that's a great point, Sarah. I would say we are a buyer of high-quality credit, and particularly high-quality credit because it has a little bit longer duration. So if the rates do adjust, you get a good risk reward. We also believe sort of speculative credit has had a run-up. and it needs to correct to be more compelling value. But I would say investment grade credit is very compelling because it has duration lift and the credit is well priced.